Welcome to the Alaska Realtor live stream. My name is Jamin Goecker, and of course, my mission is to help you to build an intentional and significant legacy for yourself and your family by coaching you in real estate. And today, I'm very happy to be joined by a colleague in the real estate industry, Melissa West with First Rate Financial, and she's going to be talking about what's going on in the interest rate sphere and try to give us a little bit more clarity about what's going on there, because I think there's a lot of crazy news and a lot of headlines that are really designed to scare a lot of people. And so really the point we want to do today, really what we're trying to accomplish, is to give some clarity on what's going on so you can make the best decisions that you possibly can. Before we get started, real quick, just some quick housekeeping stuff. As we've said a million times before, these live streams are only as good as the questions in the comment section. For those of you who are out there and you do have questions, certainly feel free to drop any question you have in the comments section. If you're thinking it, I guarantee you somebody else is wondering as well. But Melissa, I've already said quite a bit, so welcome.
Hi, thanks, Jamin, for having me.
Well, thanks for being here. So let's go ahead and just talk real quick about what your Alaska story is as people are getting into the live stream and the chat here. So what brought you to Alaska?
Well, I was born here. So I was born here in Anchorage at Elmendorf Air Force Base. Folks are from Ohio and they were brought up by the military. So I was raised here in Anchorage and lived here all my life. I own a couple properties here in Anchorage as well. So I'm a local gal that owns also.
Yeah, that's awesome. You don't meet a whole lot of people that can say they've actually lived up here for really anything over like 5-10 years. That's considered an old timer.
Yeah, we're kind of rare. There's a lot, mostly transplants. But yeah, I'm a true Alaska girl.
Oh, that's awesome. All right, so let's go ahead and just jump right into it then. So question number one is, what is happening with interest rates? This is like the $1 million question that everybody is just kind of throwing around. So
right. Yeah, I know everybody's got an opinion on what's going to happen. There's a lot of speculation. I can just tell you what the facts are. And the facts are that the enemy of mortgage interest rates going up is inflation. And we are in a severely inflated market right now. And especially when you look at how this is compared to the years 2020 and 2021, when interest rates were at historic lows. The federal government is doing what they can to fight inflation by raising the federal interest rate, but that has nothing to do with mortgage interest rates. There's a direct correlation of the bond market and mortgage interest rates. And so when the bond market does poorly, interest rates go up. And what causes the bond market to do poorly is rampant inflation.
So what is the bond market?
These are federally backed securities. They're long-term. They're considered very secure and safe. They're kind of the opposite of the stock market. You don't have as much risk involved in those. And so when you have a secure security like a bond, and you have the value of money going down, you don't want to invest in that because the value of your dollar is not going to be the same tomorrow as it is today. And so people tend to move towards, more riskier options. And so that's what's been happening all 2022. It's kind of day to day what interest rates are going to look like. There are some things that are out of our hands that we can't really, predict as far as, what's going to happen with inflation, like wars and, things like that. The war in Ukraine was not something anybody could have foreseen. And that had a huge impact on oil prices and, bumped up, inflation ticked up really quick when that happened. So yeah, that's the enemy that we've got going on right now is rampant inflation.
So would you expect moving forward to see interest rates to continue going up?
I mean, if I had a crystal ball,
I
boy,
mean, all theories here, all
all
theories. So
theories. I think that they will go down eventually, because I think the Fed is doing what they are supposed to, which is raising that interest rate, scooping money out of the economy. It's going to reduce, as much, it's going to reduce what people are spending right now, and so I think eventually it will have an impact on bringing interest rates back down. But when that's going to happen, I don't know. I mean,
yeah.
I wish I could tell you, like, wouldn't that be the thing?
Yeah, that would be nice. So for the people out there that are thinking they might just wait till they have the sweet 2.5%, 3% interest rates that we had back in 2020, 2021, what would be your response to them?
I mean, those were just outlandish lows. We've never seen anything like that. I doubt something like that would happen again. I mean, we had to have the entire, world economy shut down, right? to make that happen. So I don't see that as something that's probable. I mean, if you look at mortgage interest rates historically, 2 and 3 is just not, it's not in the, it doesn't happen. When I first bought a house almost 20 years ago, my interest rate was 7%, a little over 7%. And I didn't think anything of it. I didn't know that was not good or, anything, but I guess perspective is really key here.
Yeah, and I think unfortunately we've kind of gotten spoiled the past couple of years and thinking that 2.5%, 3% was normal.
Normal.
Which
Yeah. A lot of people think it's normal. Yeah. And it just wasn't. It never, yeah.
Yeah, no, I mean, that was, I mean, possibly a once in a lifetime kind of an interest rate because we had to have so many factors line up perfectly to make it happen. But I mean, to the people that are thinking, well, we'll just wait until interest rates drop again. It's like, well, I
You're going to be
guarantee
waiting a long time.
you're going to be waiting a long time. You're probably
Yeah.
going to give away a lot of appreciation.
Right.
But, also once the interest rates go down, it's going to be a crazy buying frenzy all over again. And
Exactly.
you're probably going to go, well, I'll wait till the prices come down. It's like, well, you can't.
Yeah. I mean, because you got to think, the buying frenzy that we had in the last couple of years was nuts. I mean, because anybody could get out there and get qualified because those interest rates were so low. I mean, you saw it in 2021, all those offers made everywhere and people offering 50, 60K over asking was nuts, so like, you can't have your cake and eat it too, right? You're going to have a problem. Once interest rates go, if they were to somehow go back down that low, there would be a feeding frenzy out there again. Absolutely.
Oh, it would probably be worse, honestly, because
So
right now, like we're starting at such a lower volume for what
we
we
have had
usually
a
have in
supply
inventory.
issue, and it's ongoing, and that supply issue has not been fixed. So if you were to drop interest rates down to 2% again, twofold, I think so. You're married to the house, right? The purchase price and the house. That's the thing that's forever. Your interest rate is not. That's something that you date. You can always refinance when they go back down, but that price and that house that you find today and the equity that you get, like, I think that's invaluable.
Yep, absolutely. So let me go ahead and share a graph that you sent over here. And it's a little warning for some of you who aren't really numbers inclined. This next little bit's going to be a little rough for you, so I'm just preparing you. But this is going to be good for you. You'll thank me on the other side. So let's go ahead and take a look at this real quick, and I'll let you kind of explain what it is that we're seeing.
Right. So this is the just a graph of mortgage interest rates versus inflation. Inflation, I believe, is the red there, and then the interest rate percentage is in the blue. And you can see kind of how every time the inflation pops up, that the interest rate kind of follows suit, right afterwards. And so the data is there that it is a direct result. One of them causes the other completely.
Right. Man, that was a really dramatic drop that we had around 2008, 2009.
Mm-hmm.
And I mean, we kind of see a gradual easing, gradual coming
Yeah.
down, but yeah, it's
There was a bunch of bailouts and things, I think, that happened there, and so that's why things didn't go too awful. I mean, all the monies that was spent by the federal government during the COVID years, that's part of the inflation we're seeing now.
is that kind of what the delta is? Kind of talking about those bailouts, because those spike up right during this time too.
Correct. Yeah.
Okay, that makes sense. And I see the delta is coming way down. Obviously, inflation rate is really increasing here.
Yeah, you could see it's spiking up.
Yeah.
Mm-hmm.
Now, how long does it usually take? Is it like an instantaneous kind of a thing where we see a big spike and see a big spike in the interest rates, or is it kind of a lead and lag indicator kind of a thing?
I think there's a small lag. It's not instantaneously, like moment to moment, but every time there's an announcement by the Fed about job security or inflation rates, on if they're increasing or decreasing, there's a direct result in the bond market that day. I'll tell you that. Every time there's an announcement, we see interest rates be affected immediately. Mm-hmm.
Yeah,
Whether it's good news or bad news.
No, I can see that. Man, that is some crazy inflation.
Yeah, I mean, look at that back in the early 80s. I mean, they were in the double digits. So when you think about it, 6% is like, not so bad.
Yeah, well, I mean, that's really what I like about these graphs here, is just to show people, hey,
perspective is huge.
Yeah, the perspective is huge. Like, I actually saw a graph a little while ago where they were really breaking down, okay, adjusted for inflation. Let's take a look here at once you adjust for these high interest rates, and they had lower prices back then, but higher interest rates, and now we have higher prices and lower interest rates, much lower than what we used to have. There's only, once adjusted for inflation, there's only about a $50 difference between owning a house back then and owning a house now.
Right.
But I mean that doesn't really sell a whole lot of newspapers or get a lot of clicks. Just saying.
Exactly.
Hey,
yeah.
We're about where we were. Yeah, it's just not as exciting.
There's a lot of inflammatory news going on about things and why trying to scare people, and why you shouldn't buy, and I just think that you need a place to live. Why not have something that you're going to keep forever, and you'll get equity out on the other end?
Yep. I don't know. Absolutely. So we've got a question real quick from Mr. Steve. Let me pull this up here. So kind of talking a little bit about advantages and disadvantages of financing with a local independent lender versus a large national lender versus a broker. So I'll go ahead and answer that a little bit on my side, and I'll let Melissa go ahead and jump into it as well. When it is a lender that the listing agent is more likely to recognize, because that lender is involved in the community, and they've got roots down here. These are people we live with every day. It looks way better if you're coming in. There's a lot more credibility there, because that local lender is going to be a known quantity. Whereas if you have a large bank, a large lender, a large brokerage, that are out of state. It's kind of a big question mark for a lot of people because it's becomes very bureaucratic, and I just can't guarantee how things are going to go. So if I'm looking at it, talking with my seller, it's like I've never worked with this enormous out of state lender. They could be great. I know for sure this local lender has a great reputation though, and we've got, they've take good care of their people, and they've got a competitive interest rate and all that good stuff. So that's
Yeah.
just kind of from the trenches my perspective, but I'll let Melissa jump in here.
Sure. I mean, truly, that is a factor for listing agents, absolutely, to picking your offer for sure. But another great thing about someone local is, we've got skin in the game, right? We don't have Rocket Mortgage Super Bowl ad money, right? We every deal matters to us because that's our name and our reputation out there in the town. These are our people. We live here too, right? And so for us, it's a big deal if we lose, the business, or we don't do our job correctly or something like that, versus a local or a big national lender. For them, it's just next. Who's the next one? They don't care. There's no care there. They're not here. I've taken some deals over from big national lenders, and one of the biggest complaints is you can't get a hold of anybody. I'm on the Alaska time zone because I'm here, right? You can call me. I answer the phone too. I don't put you through a press digits and find, to speak to human kind of a thing.
Yeah, well, there's that, but then also some of these large corporations and companies, they may or may not know how things work in Alaska.
Exactly.
And so a lot of these listing agents, they're like, oh yeah, they for some reason think this requirement is really important. So that's going to be an extra hoop we have to jump through. They don't understand how to read a well report.
Right.
They'll
We'll ask for things like termite reports, and you're like, we don't have those here. Like, what are you talking about?
Yeah, I mean, it's kind of like the same thing. If I'm going down to Florida, then I'm going to be working with like a lender down in Florida
Someone in
because
Florida. Yeah.
yeah, they understand how the market goes there, and I
Mhm.
every intention of writing their
Yeah.
reputation.
Yeah, we're a unique market up here. We have a lot of really interesting, like really cool stuff, that maybe people are not used to in other places, and other lenders will not understand why you can't put a driveway in the middle of January, right? Like they won't get it.
Yeah. Or why it's difficult to go and install a brand new septic tank and leach field in the winter, which we're having to do that right now. Not pleasant, but it is doable. Not pleasant though.
You're right. Yeah.
All right, so let's jump over here to this question then. What will impact interest rates moving forward? And it sounds like before it's really that bond market. Is there really any other variable that plays into it, or is it really just like a one for one?
That is kind of it. It's a direct inverse correlation between bond market prices and mortgage interest rates. Bond market prices go down, interest rates go up.
Gotcha.
It's direct correlation. That is completely what they base the rates on.
Gotcha. Now, is the bond market, is that connected at all to the stock market? Like if this bottom falls out of the stock market, does that impact the bond market as well?
No, I mean, it's just like any security that, there's investors that are investing based on whatever they feel, within the market. And, that might have some sort of effect on how investors feel about things, which could then impact the bond market. The other thing to think about is it also depends on what loan program you're in. Interest rate, there is no like one interest rate. There are more secure government-backed loan programs, and then there's conventional products as well, and all kinds of varying degrees of things within there. So more secure government loans tend to have slightly better interest rates. Those are VA, USDA, and FHA. And that's because they're backed by those entities. So it's more secure.
Yep, absolutely. Okay, so here's a thing that I'm sure everyone is probably thinking about, and what can people do to increase their buying power? I mean, that can be a little frustrating right now. If you're looking, you're seeing interest rates going up, you're feeling your buying power kind of slip away from you. But what can people do right now that's gonna put them in the best position to win?
Best thing you can do is get with your local lender or broker and apply for a loan. Get started on that process. Work on a pre-approval as soon as possible, even if you're not ready to buy yet. Because what that does is it at least starts us off with a picture of where you are and where you want to be and what it's going to take to get you there. If you wait until you find your house that you want, well, I mean, it's far too late then to make a 6-month plan for you to pay off these debts and increase your FICO score or something like that. So the best thing you can really do is go and apply, work on a pre-approval early. Then you can start with goal setting and figuring out what it is that you exactly want and how we can help you get there. Because there's some pretty basic things that go into increasing your buying power. Number one is make more money, more income. It means you can buy more house, right? Another one is less debt. There are thresholds that you are allowed to go to with respect to debt to income, depending on the loan program you're with. But if you have less debt, that means you can usually buy more house. You can put more cash down. That is another way you can definitely, get a higher purchase price if you put a little bit more money down. And then also increasing your FICO score. When you have a higher... Sorry?
What's the FICO score?
Oh, your credit score. Everyone's favorite thing. Increasing your FICO score just opens up more opportunity for different loan programs. When you have a lower score, you're kind of more limited to what you can and can't do. And so, it's not astronomically different, but it can make a difference if you have a better credit score. So getting pre-approved, having a mortgage broker take a look at your stuff, we can look at your credit report and look at your FICO and give you some pointers and tips on how we can make that better. It's kind of amazing what you can do once you have a plan in place. I've seen some pretty incredible things with helping people with just those basic things, helping them get their credit score up. We paid off some debt things and wow, they were in the position to buy the home they wanted, in a short amount of time. So it can be done, but you got to be prepared. Because if you get out there and find that house you want and you haven't done the pre-approval yet, man, I don't know, that house might just not be, it's gone, it's gone by that time.
Yeah, you're probably just going to see that house sail away if it pops up and you're not already ready to go.
Correct.
So let's do this. Just how dramatically does a credit score impact what you can qualify for in a house? Like, let's say I'm rolling in with a 600 credit score and there's somebody who has like a 750 credit score. Like how big of a difference, all things even, do you think that would probably make?
Well, the person with the 600 credit score would be limited on which loan programs they would qualify for, depending on what they had going on. If they were a veteran, a VA loan they would qualify for that. If not, then you're more looking in like an FHA program, and those have slightly different debt to income thresholds that you have to meet. You also have to meet an automated underwriting system. When you have a lower credit score, your approval within that system with Fannie and Freddie is often a little bit lower. And so your threshold is even lower on what you can go up to versus somebody with a 750. I don't know if I could put a dollar amount on exactly how much more, but you can go a lot higher, right? You're definitely looking at, you have more options, you have more loan programs that you can get into, more conventional products, and definitely your automated underwriting threshold will be higher because you have that better credit score. So, it's hard to say a dollar amount, but I mean, it could be the difference between, the house of your dreams, it's $50,000 more versus, one that you could just kind of like. Right.
Gotcha. Okay. Well, I mean, that certainly does make sense then.
Mm-hmm.
And let's go and do this real quick. So I think we did a little chart here before where we were talking about kind of running somebody, a hypothetical person through the lending process here. Was that the? Yeah, I think it was the process. Yeah. Okay. Let me pull this one up real quick. So for those of you that are wanting to jump into it, this little graph or chart that we're going to be showing here is just kind of a breakdown for what you can expect to be paying and when you're going to purchase a home. So Melissa, you should go ahead and kind of break this down a little bit and help us to make sense of it.
Well, this is just a snippet of a cost estimate, a closing cost estimate. This is the buyer's side. The things that I wanted to point out that people don't often notice are the things that are highlighted there. So the yellow ones there, the processing fee, underwriting fee, doc prep fee, those are not real fees, if you will. Those are lender fees. The rest of these are all third-party fees that are associated with the transaction. So, with the transaction, you're going to pay for an appraisal, right? Obviously, that goes to the appraiser. Your credit report's pulled, that gets paid to the bureau. You have title fees and tax fees and things like that are definitely associated with the transaction. But the rest of those four that I have highlighted there, those are for the lender. Those are their fees. And why they break them out like this, I don't know. This is not something that I do or that First Rate does at all. And I think it's kind of a way to hide some fees, if you will, and make them look like transaction fees, but they're not. Those are just going to be paying for your rate. So the blue one I have highlighted is the discount points. And what these are is, you can get whatever rate you want, right? You just have to pay for it. That's the case with all lenders. You just have to pay an upfront fee to the lender to get a lower rate. So discount points is their way of stating that you're paying for the rate, to be lower than what it was. So watch out for that when you get your cost estimates from other lenders. Look for those things that I highlighted and add them all up, because that's truly what it is that you're paying for your rate.
Yeah, and they might be mislabeled. They might do some rebranding and call it something different.
Yeah, I've seen a lot of different things. That's just one I pulled from a recent estimate that I got from a different lender. And yeah, they can be so expensive. I've seen some outlandish things on there charging thousands and thousands and thousands of dollars. And I don't think people would have known, why would you know that that's what it is you're paying for,
Yeah, like I remember, and I bought a property back in 2020 that I did have the opportunity to get an interest rate locked in at like a 2.2, but it was going to be like $10,000-$15,000 worth of discount points. So it's like, It's going to take me about 15 years for this to even make a difference. So
exactly. You need to look at your recoup, timeline. How much is that saving you a month? And how long is it going to take you to recoup what you've spent up front? You don't want a recoup timeline of like, I don't even recommend it for more than 2 or 3 years, because chances are you'll be able to refinance or, will you be in that house that long? Like there's a lot of things to think about. And if you're going to sell or, maybe upgrade, I mean, there's all kinds of stuff that you don't want to be paying this big fat fee. And then it takes you 15 years to recoup for the savings you made. Like that's outlandish. So truly be very aware of not just what interest rate the lender says they can give you. What does that interest rate cost you? That's what you want to know.
Yeah, I mean, so the issue that I see a lot of people run into when they're looking at getting a loan is everyone, I mean, myself included, just kind of gets fixated just on the interest rate. And I mean, just kind of at the expense of everything else. And that's really where things can start going sideways on you real quick,
Yeah.
because there are some predatory lenders out there that are aware of that.
Yes.
They're going to feed into it. They're going to say exactly what you need to hear, what you want to hear. And they're not going to educate you on, okay, so it's a lower interest rate, but
you paid for it.
You're paying for it, and you're paying
Right?
a lot more than if you just went this route.
Exactly. Yeah. I mean, we don't, like I said, we don't personally do anything like that. We don't have those kinds of fees. But I know that a lot of places do, and I don't want to throw anybody under the bus here, but yeah, it's definitely a thing that needs to be looked further at. You need to take a look at what it is that they're actually selling you, right? Because it may look real shiny and pretty, but what's in the fine print,
Yeah, I've seen the ads, and it's like, yeah, someone's probably gonna have a class action lawsuit brought against them eventually. All right, let's get to the comments section real quick. So from the Hotshot 01, if relevant to this topic, on the thought of doing renovations right after buying a house, are renovation loans similar to house loans? Are interest rates similar? Compare differences and strategies.
Right after buying a house. Are you meaning like doing some repairs before you buy, like a rehab loan, or is that? Do you think? Sorry, my cat's meowing.
That's your cat? Like I thought it was a child.
No, it's my kitty. Oh no, I think he's gonna throw. Oh, but let me see. So I don't really know exactly what kind of loan program he's talking about. Like, are we talking about like pulling out some equity, like a HELOC or something, and doing some things, or?
Well, let's do this. So what is kind of the big difference between a renovation loan and then like most other loan types that are out there? Because I think there's a lot of confusion around those, because I know a lot of people, they see properties that are definitely going to need some work, and they're like, oh, this is automatically a deal. And it's like, not necessarily, just based on all the actual numbers. So first off, can you kind of explain how a renovation loan works?
So rehab loans or renovation loans are like there are 203K is one of them that's done by FHA. These are long loans. They take a lot of time. They tend to be very difficult. The way they work is the loan is not funded until the work is complete. So, and it can't be the work cannot be done by you or somebody your brother. It's going to be a contractor that the lender chooses, or they'll give you like contractors that they will allow to do the work that needs to be done. So it can be very difficult, because what will happen is there's squabbling with what's supposed to be done, what shouldn't be, what the lender wants done versus what you want done, and what the contractor will do with what they're being paid. So they're very tough in that you don't actually get to live or move into the house, or like you don't have possession until the work is complete. So they're tough. Yeah, they're not what you would think, that you could just get this money to spend on repairing these things. That's not how it works at all.
Yeah, I've done a couple of these before, and I mean, my advice to everyone that does it is, okay, well, you're going to cry at least once. Like, are you sure? Because
Yeah,
this is going to be a long haul. We're probably
yeah.
looking about 6 months out before we're ready to.
6 months is pretty standard, I'd say, for one of those. So if you're in a position where you need to move or live or something like that is not the loan for you. Yeah, you got to have some real patience to get through those.
Absolutely.
You
Would
know,
you say like the interest rates though, and like costs and all that for doing the loan is pretty similar for um
typically they're pretty similar because it is, I mean, it's still an FHA loan, and so they will be rather similar to what you would get for just your standard FHA loan.
got it. Okay. So not a whole lot of differences there. You're
Mm,
going to have some kind of budget built into the loan for the
right,
renovation, and the work is going to be done before you get possession. And you're,
right,
if you happen to be handy, awesome. Not going to be applicable here though.
right. Yeah, yeah. You cannot do the work, which is what a lot of people want to do. With a fixer upper, you want to get in there and use your hands and do it. Save a buck there, but that's just not part of the deal.
Yep. I mean, believe me, I've yep, seen that before.
Mm-hmm.
All right, coming in from Mr. Steve again. Any thoughts on USDA loans? This is another one I've heard quite a bit about recently. Um, of a lot of folks that are looking for some more rural. I'm not going to say off grid. Ah, dang it! I just said off grid. Okay,
They're
looking.
great.
Yeah, awesome, love them.
No,
But you get
you just
a lot of these more remote properties. So, what are your thoughts on USDA loans?
I think it's a great loan program. Personally, I appreciate what it does, and for people, it's a zero down program, which is amazing. And all of the valley qualifies. So anywhere in the Matt Valley gets the thumbs up from USDA. There's properties in and around North Pole, I know, that qualify, and basically, anything in Anchorage, absolutely not. Eagle River, absolutely not. In Fairbanks proper, absolutely not. But kind of outside of that, it's probably a USDA qualified property. These are difficult in that they have income restrictions, so you can't make too much money to qualify, and those are based on the income levels are based on the entire household, so whoever's in there. So even if your wife or your husband or whoever is not going to be on the loan, we still have to count their income as part of qualifying for the USDA program. So they add up all the monies you could potentially make, your dividends, your kids' dividends, any kind of a little small, they want to look at your tax returns, they scan it looking for businesses, things that you could potentially be making money, and they want the whole household. So if you've got your uncle that lives with you and he has a job, guess what? His income's counted too. So they're difficult in that aspect. They have a very low debt to income threshold that they allow. They're not as high as any other loan program. They are the lowest. So you can't make too much money, but you have to make enough to have a low debt to income. So they can be tough in that respect, but for the right person, a zero down program has gotten people into homes that otherwise couldn't.
This really sounds like a Goldilocks kind of a loan.
Yeah, it is. You got to be just right.
Yeah, and man, yeah, that's. I was definitely wondering. It's like 0% down. It's like, oh shoot, why aren't we all doing USDA loans? Oh yeah, that's why.
Yeah, not everybody qualifies. It's kind of tough.
Yeah,
Um,
what are like the income shutoffs? Like, at what point do you make too much and they're going to kick you out to another loan type?
It depends on how many is in your family. So there's different thresholds for how many people are there in your family. I want to say for two people, I don't think you can make more than don't quote me on this. It's around 120-ish. something like that. Feels about right for the year. 120K for the year.
Gotcha.
As you increase the number of people, that number gets bigger on what you can make. And so you just need to be under that. So, for example, somebody with a couple or whatever with a lot of kids, they have an easier time because they have a higher per person, income allowance.
Gotcha. So for a lot of people, it's either make less money or have more kids. Those are the options that are on the table.
Yeah, I mean, a little bit.
Outstanding. So let me jump over to a question real quick here from Tanya. Which, guys, thanks for the questions. Keep them coming in here. Another question from Tanya. In your experience, are appraisers fair and diligent in Alaska, or are they just making a paycheck and appraising at whatever the contract price is? I'll go ahead and answer this first, and Melissa, I'll let you jump in. Sure. It's going to really depend on the appraiser. Some of them are really diligent. They're really on top of it, and they're awesome to work with. And I've got a decent enough professional relationship working with them. And I've got other people where it's like, oh, Lord. No, not this one. It's going to be late. It's going to be late. I'm going to have to probably call this person and try to use a lot of tactful negotiation to get them to the realistic market value based on what the stats are actually showing. So it's kind of a mixed bag. Unfortunately, there's no free market option to kind of weed out the incompetence, though, which, yeah, guys, they are out there. Anyone in the appraisal industry, they are out there. You get incompetence in every industry. If they were real estate agents, the free market economy would weed them out. But the way it works with the appraisers, though, in order to avoid a lot of collusion between real estate agents, lenders, and appraisers, what they did is they said, okay, we're no longer going to let the lender or the agent go and pick who the appraiser is, because if we do that, there's a lot of chance for corruption, that the lender pre-qualifies them up to, let's just say, $700,000. The agent goes in, makes an offer for $700,000, and lo and behold, the appraiser just goes in and says, yeah, it's worth $700,000, and everybody rides off into the sun, but that property might not be worth $700,000. So that's why they created kind of a random selection system where as soon as the funds are forwarded or advanced to get the appraiser underway, then it kind of goes into this random selection, picks one and off we go. So that's what it's designed to do. And unfortunately it keeps the incompetence in there. The thought is that it definitely keeps the corruption out too. So, it's not, you hear me complaining on here, but it's not all bad either. I see the logic.
It's for your protection. It's for the buyer's protection, to have impartiality from and no influence by realtor or lender. When we order appraisals for people, it's a completely different company. It's a third party appraisal management company, and they order, they just pick, like Jamin said, just whoever's available and can take the order, and it's a random, it's a grab bag. You just don't know who you're going to get. And it should be that way, I think. I mean, I don't like it either, honestly. I wish that I could get rid of some of them, but it needs to be that way to keep things fair and to protect the consumer out there and make sure they're not getting swindled.
Yeah, I mean, really, best case scenario, I wish we could just live in an honest world where the appraiser is going to do their job and
we're not going to,
and everything, everyone's just going to do what they're supposed to do. But, unfortunately, that's not where we live. So that's where we're at. I'll also say, if you are looking at doing anything in real estate in Alaska, but the lending option, the real estate agent option, aka real estate licensees, as they are legally called up here in Alaska, if that's not really your cup of tea, you might want to check out being an appraiser, because it's not a very big pool. And there's always going to be plenty of almost guaranteed work for you. So there you go.
Definitely a need for more appraisers in this entire state.
Yeah, well, the way the system is set up, and I've talked with people before, is the way the system is set up with the appraisers is it's just very difficult to get fresh blood in.
It
And
is.
so, we've just got like this aging appraisal industry workforce.
The apprenticeship requirements for appraisers up here is some of the just most ridiculous of anywhere. I believe they have to be an apprentice for, I think, 2 years. So they have to, follow around somebody who's going to be their direct competition, right? So like, who wants to train somebody to be their competitor? You have to.
Unless it's like a family member or something like that.
That's where you see the generational appraisers, because that makes sense. It stays in the family, but it's a tough industry to break into, and because of that, we have an aging appraiser population, and it makes it tough.
Yep. Sometimes we'll get that property that has 1 million stairs on it. And it's like, Brenda, you you might want to stretch before you do this one. It's you're going to get a workout today.
Yeah. But as far as it being fair and diligent, I think I like to think that people put their best foot forward, and it's all we have, we have to take their report. So
yeah, and very, very rarely, okay, I've had this happen once, okay, but very rarely if something comes back and it's just obvious that the appraiser is off for some reason, like they missed something, then agent can very tactfully, go and talk with them. You do not call them out in some big grandiose gesture, call them an idiot, blah, blah, blah. No, you very tactfully go talk to just them one-on-one.
Yeah.
And sometimes you can get them to adjust their opinion based on the new data you've been able to bring to them. I have actually done this before and ended up netting my sellers an additional $20,000 just because that's what the market value was.
Right.
But that's not normal. You get a handful of those every year. I was just lucky that mine happened to work.
Yeah, you can challenge what an appraiser says if you bring good comparables and if you can win. Those are tough wins, though. Really, really tough wins.
Yeah, indeed. Well, Tanya, you have really triggered the real estate professionals here, so I'm going to go ahead and move on to a new topic. Okay, so let's talk about this real quick then. When does it make more sense to buy versus to rent, in your opinion? And we've obviously got the graphs and everything here, but do you want to talk about it first and then dive into those?
Sure. Typically if it's going to be a short-term kind of a situation, 2 years or so, and you're not going to be there anymore, and you don't want to rent it out, and you don't want to, be in the state or pass the house on to somebody else or something, because I feel like there's so much you can do with it, even if you aren't going to be here for in a couple years. Rent that sucker out, make some passive income on the side. But if it's short term and you're leaving, it might be a better idea to rent, just because the upfront costs, the closing costs, and then to sell the place, you might not come out ahead.
Right. It does cost money to actually sell a house, and that's something I don't think a whole lot of people realize.
Exactly. You're paying to get in, and you're paying to get out too. And so it needs to make sense in that aspect of looking at what those costs are, and how long it'll take you to break even if you were to just rent instead.
Right. So let's go and take a look at a couple graphs here real quick then. Just kind of illustrate what Melissa's talking about. So can you kind of kind of explain the scenario we have in scenario 1?
Yeah, so this one is like the worst potential case. So this one is assuming that your rent never goes up, right?
Which
Which
that's
we know that
gone
that's
up.
total
Yeah,
baloney, right?
yeah, I think it's gone up about usually around like 10, 11, 12% year over year
Mm-hmm. So this
here
is
in Alaska.
your
Yeah.
rent is the same. Your rent is this whole thing is based on a $330,000 house, right? So we're probably looking at a modest 3-bedroom, 2-bath home, right? And what those rent for here in Anchorage, I mean, the cheapest one I saw was maybe around 2,000, but they definitely go up from there. And so I'm given worst case scenario here, right? So we've got 2,000 in rent, and that never changes. And then you buy versus buying a $330,000 house. I put it at 7% interest rate, like really high, just to give you the worst. And also that the annual appreciation of the home is only, I think I put it at 3%, which, Jamin, I know that it's quite a bit higher than that. Our home values have increased. I think it was, you said, 6 to 8% typically.
Yep. I mean, it kind of depends where you're at, but
More.
yeah, usually, yeah, even more. I mean, if you're in the Matsu, it was up by 15 for a while, but I'd
Right.
say across the board, um, we'll say 7 to about 10% is pretty normal.
Right. So this is your rent never goes up, and we're in the most sluggish market that has existed up here in a while. So what you're looking at here is your break-even point is in about 3 years. So and just you can see the math breakdown there. When you buy it, that's what you're spending on the cash you spend on your mortgage for those 3 years versus what you spend on your rent. And then if you were to subtract the home value and the new home value after 3 years, appreciating at 3% a year, which we know it will be more than that. You get rid of the balance of the loan, and then the closing cost to sell the house, and you end up spending more renting in the end, and it just breaks off from there and becomes exponential at that point.
Yeah, I mean, there's really no comparison after year 3, and even then, I mean, it's pretty neck and neck, like right up to that point.
Right.
Now, one thing I just want to point out to you folks, so that obviously is not going to be including like the cost of repairs if something breaks down, like you need to have someone come over to take care of the sink. You do have a little bit more expenses there, but all the variables and factors here have been very, very conservative. So I feel like, I feel like that's
I put it in a 7% interest rate. I put in a percentage and a half for taxes, which is pretty high. Home insurance, $1,000 a year. And I did include annual costs of about 1%. So those are kind of your repairs and things that you're looking at. And then the selling costs at 6%. So.
Oh, look at you go. You did get that in there.
Yeah,
okay,
it's in there, man. so even then, you still
I stand corrected.
Yeah,
I stand corrected.
It's all in there.
So proud of you. All right. Well, let's take a look at the other graph then. And this one
is more realistic.
Yeah, this one's a little more realistic based on what we're actually seeing here in the market.
Yeah. So this one is assuming, even though it's more realistic, it is still very conservative. I'm assuming that rents go up 2% annually. That is likely very much more. And I'm assuming that your value of your property is going up 6% annually. So again, very modest. And you can see you break even right here in year 2, and they shoot off from each other there. And year 2, even it's a pretty big difference. You look at what your rent costs are versus your buying there. It's almost immediately that you're better off.
Yeah, I mean, stuff like this really does make you stop and kind of think a little bit more in the long term,
Mm-hmm.
instead of just looking in the here and now. You and I were talking before that, I know somebody that was renting from a apartment complex here for about 40 years. So 40 years. And unfortunately, after all that time, this guy fell behind on his rent. And because they have to be fair to everybody, they have to treat everybody the same way, even if they've been there 40 years or it's a fair housing violation. They had to evict the guy when he
Yeah.
fell behind on his rent. And I mean, that's heartbreaking because had he bought a property like in Anchorage in the 80s, like he would be pretty set right now. That thing would be paid off. He could refinance it if he wanted to and pull a bunch of cash out. He could,
Mm-hmm.
sell it, move somewhere else. I mean,
Oh, the
yeah.
home value alone. I mean, whew. Yeah, what he could have, what he put into it versus what he would have ended up with, it would have just been astronomical. Absolutely.
Yeah.
I mean, if you think about, what you pay in rent, you're paying 100%, right? 100% rate is what you end up paying, you end up spending versus, a 7% interest rate, which is what I put on this example. Doesn't seem so bad when you consider 100%, right?
Yeah, well, I mean, especially when you consider all the tax benefits and everything else that you get
Mhm.
in there too. So yeah, I mean,
Yeah,
it's really, the system is set up to incentivize home ownership.
it is.
Now, I will say there is a time and a place for renting, and the time and a place is usually where it's going to be very short term, or it's going to be some kind of scenario where you just need a lot of flexibility. Like, let's
Hmm.
say you're moving into an area and you've got some kind of a trial period with your job. All day as a real estate agent, I'm going to be
Totally.
recommending you rent because you got no clue, these, if during a trial period, if they're going to be sticking with you or not. And yeah, I mean, just stuff like that, it's probably going to be a better idea to rent. If we're looking at just the straight hard numbers, though, it's no it's no comparison though. But very, very small sliver of the time though does renting actually work. And if it does, then I am definitely going to be telling you so, because I really don't like the idea of sticking somebody into a house and then like 6 months later they're like, okay, we need to move. And it's like, you may or may not be able to do it. Now, I have had some people recently, this is just how crazy the market was there for a hot minute. They moved in, and then like 6 months later, not even that, I think it was like 4 months later, like they were needed to move because of some personal reasons. Like I saw the call coming in, and I was like, oh, something happened with the house. Okay, game face, here we go. And it's like, no, we need to move. And they were actually able to sell and still net a profit off of it.
Wow. That's crazy.
So I mean, that's just how crazy, yeah, the
Mhm.
appreciation was there for a while. It's still
Yeah.
not going up quite at that rate, but so you can't expect that to bail you out every time. But it's great when it works.
Mhm.
All right, let's go and take a question from Tanya real quick here. For someone considering moving to Alaska with a remote job and continuing to work for that remote company, does that affect anything on a local lending side or standard time in job and income?
No, it does not. You can absolutely, if you have remote work and you can do that up here and your pay will not be affected by a move, then yeah, we get to use whatever income it is that you're going to make. Absolutely, and that for sure counts as time on the job. That will count towards your 2-year work history. Absolutely. Yeah, I deal with a lot of people that work remotely. It's very common, these days for people to be able to work from home or whatever, that they don't have to be in the place where their job is, and in the mortgage world, it's seen exactly like that. Well, If you can live there and do that job, then great. That counts. Yeah.
Yep. Absolutely. Absolutely. Now, real quick, I think my battery is about to run out on the camera, like I mentioned before. So I'll let you go ahead and do this. For anyone looking at getting a loan going, what are the things that they need to get together?
To get get going on pre-approval?
Correct. Yep.
Okay. So filling out a loan application is step number one. That way we can look at what you have going on in your life. And we can ask for the documents needed accordingly. Typically, what these are if you're a W-2 employee, you have a regular job. We will need 30 days worth of pay stubs. We'll need 2 years of W-2s. If you've changed jobs, then just whatever your W-2s that cover the last 2 years are. Typically, we'll need a bank statement, a copy of your driver's license, any kind of a thing in your life that is a liability that won't show up on your credit report. For example, spousal support, child support, things like that. Those don't typically show up on credit reports, and so we'll need copies of any kind of orders that you have for those. If you're self-employed, we would need 2 years tax returns. If you own rental properties, definitely 2 years tax returns. If you own any, if you've got like partnership income, K-1s, business tax returns, pretty basic stuff like that. What mortgages want to look at is your last 2 years. That's what you got to think about. What have I been doing the last 2 years as far as work and where I've lived? They just want to see the last 2 years. So those are the kinds of documents that you would need to gather to get yourself pre-approved.
Yep. And I mean, it is tax season right now. So we're obviously 2023 right now. Do people need to have all their tax returns done for 2022, or can they do the 2 previous years?
Not necessarily. It depends on what we need tax returns for. So you don't always need to submit your tax returns either. Like I said, if your main source of income is a W-2 job and you don't have any rental income or properties, then we would likely never need to look at your tax returns. That's not something we would care about. Lenders will, if you were using tax return income, they would prefer to see the most recent 2 years, but you're not supposed, you don't have to have filed them until April, right? So lenders won't require that they see the most recent year until after April 17th or whatever it is this year. And then they'll say, okay, either you show me an extension or the taxes that they filed. So you don't have to have them done, at least not right now. And if we're not using anything from them, then you don't need to have them done at all. I mean, go do your taxes. Don't do that.
Yeah, don't put it off. Don't put it off. Just get it done.
Do your stuff for sure. But from the lending side, the mortgage side, if you don't have any rental or business income, Schedule C, Schedule E, something like that, then typically we won't need to. The only exceptions to that are when we were talking about USDA loans. They will require you're looking at your tax returns because they want to make sure that you're not making money in any other kind of way. So that's the only loan program that they will see them no matter what.
You better be pretty straight-laced if you're looking at doing USDA then.
Yeah. No sneaking anything in with them. They'll sniff it out.
Yep, indeed. So this is actually a good little segue here then. What are some sketchy lender practices that you've seen? We're not asking to call anyone out. Just the activities, not the people, though.
Yeah. I mean, the biggest ones are those closing costs we talked about earlier with making up fees to charge that aren't real because they just want to get you in with that interest rate that you're paying for, right? Another practice that I've seen that is sketchy and awful truly is where there's a bait and switch that happens, they like to show some kind of an upfront cost estimate or sheet, and they don't actually lock your loan in. They don't get you that rate that they told you that you could. The market shifts, something happens, you end up at closing, and all of a sudden your interest rate is so different, or there's these massive fees on there out of nowhere, and you just want to right, you have your movers set up, like you're ready to move, and it's like, well, pay
$30,000 in discount points.
Yeah, whatever. Yeah, exactly. We have to pay this, or like you don't get the house, and by that time you just pay it, right? Like I've seen it. It's really sad, because they just end up going, well, I have movers scheduled on Friday, like I have to be out of my apartment. And so you just sign the thing and move on. That's really sketchy. And I hope that doesn't happen to any of you, but I've seen it. It's sad.
Yeah, well, let's hope not, because they're in the right place and they're talking with the right people, so that ain't going to happen to these folks.
No.
All right, so for those of you in the chat section, we've got a little bit longer here, so this is kind of your final call. If you have any questions, concerns, this is your chance to get them, get any questions you have answered by a bona fide lender who can actually answer this stuff for you. I can give you general theories and concepts, and this is the person that can actually go in and take a deep dive, though.
Sure.
So let's ask this then. What do most buyers not know that they don't know about loans and the entire lending process and everything involved?
Well, I think the biggest thing that I see out there is people disqualify themselves before they've even done anything, right? Let somebody who knows what they're doing, let me take a look at it, and I'll tell you if you're qualified or not. Don't think because, you weren't working here, you had a job gap, or your credit got destroyed from something like that's, it may not be as bad as you think. And there are creative solutions, and there are different workarounds that we can have to work with a different kind of borrower, right? So, there are some low credit options. There are, different programs that allow some things, and some of them don't, as far as, job history or how we can use your income. And so I think the biggest misconception is people think because of, they think that there's one of these things that makes them not qualify. And maybe you do, you just don't know unless you try. So have it looked at by somebody who knows what they're doing. And if there's a way we can do it, we will. Or at least from that point forward, like I was saying before, now we have a plan to get you there. Don't discount yourself before, you've even had anything looked at. Because there's a lot of really cool things out there that you just don't know until you try.
Yeah, I mean, one thing I would kind of add to that, once you're kind of in the mix and you're doing a lot of doing some stuff with loans, you'll come to find out there are a million variables, and it seems like, it kind of feels like after a while that, they're just there, like, to be the ruler wrapping across your knuckles every couple seconds with this new variable. But those variables can also come in clutch, because sometimes you can kind of pull a lever kind of one way a little bit, and it actually works to your benefit. So there's a ton of variables. Some of them work against you. Some of them can be manipulated to work for you. So it's really just about who you know and can actually work the system really well for you.
Yep. It's a puzzle, you just have to find the right way it fits for you. Everybody has a whole different, thing that's happened in their life. And I like to say, I don't really turn anybody away. I just say, like, not yet. We have a plan, at least going forward, to make home ownership possible for you eventually if you do these, these things. I've seen some pretty cool things where lenders had told people no, and they came to me, and I was like, oh yeah, we just got to do, manipulate this and that, and it worked, and they're in a house, like they have a home. So don't discount yourself before. Let me take a look.
Yeah, don't give up until the lender gives up.
You're right. Yeah. Yeah, absolutely. There's a loan program out there for you somewhere. You just got to find the one that fits. Mm-hmm.
Exactly. So when is the best time to talk with a loan officer or a loan broker?
ASAP. Yeah, right away. I mean, I can't stress that enough. That really, it doesn't cost you anything other than your time. But we can help plan your life, right? I mean, these are big things and big topics we're talking about, and we can help you get into a better situation for your family and financially to even build a portfolio of real estate that maybe you didn't think you could, but maybe you can. So getting in it and getting with us right away is the best thing you can do, because you can absolutely have, get that plan in place. And when the right house comes up, you are ready.
Yeah, there's really no disadvantage to talking with a lender earlier in the process than you might think. One question I did have, I think there is a lot of kind of misconception going around on people having dings on their credit with lenders pulling the credit and taking a look at it. When does that happen? And is it something they need to worry about if they're getting pre-approved?
So yeah, this is a thing that is brought up a lot. People are concerned about having their credit pulled just in general, because there's a lot of misconception about how horrible it is. Like, don't look at the credit, everyone wants to hide from it. You need to look at it. Like, you need to look at your credit from time to time and make sure that, that things are okay with it. I will say that when we pull credit, it is coded differently than, for example, a consumer debt pull, right? These are much different. This is a mortgage pull. And so the impact, it's less impactful than a consumer debt than if you're going to, open a Home Depot card or whatever. This is a mortgage pull. And you can get as many of these as you want within a window. I think it's about 45 days. You can pull, and it only counts as one. So that's something to keep in mind. And I have not seen it do too much damage to people's credit, if I'm honest with you, where I have pulled and then they didn't find a house and decided to wait a little while and came back, and I pulled it again, and it was like the credit was exactly the same. It hadn't been affected at all. And we need to do a pull to pre-approve you properly. So just know going in that is something that we will need to do. I can take a look at your stuff without pulling your credit, but I can't give you a full, real answer without having those scores and taking a look at what you got going on in there,
Yeah. So when there's so if there is a ding on the credit, like how much of a ding would it usually be? Because I've had
a couple points.
Okay, because I've had some people, they're like, oh, my credit score dropped by like 40 points. It's like, I think you probably had some other stuff going on.
Yeah, it's not going to be that kind of drastic of a ding, just in a general sense. Something like that is something bigger going on your credit report. A credit inquiry and a hard pull for shopping for a mortgage is not a detriment to your score.
Right. I mean, it's probably going to make up for it by like the end of the buying process.
Yeah, exactly. When you think about the 2 or 3 points you could potentially lose, it's really not that big in the big scheme of things. That and losing a couple points is not usually a deal breaker for us either, to be able to qualify you. So, yeah. So don't be scared. Don't be scared. You got to look at your credit sometimes. You got to see what's going on in there, and that way we can help you move forward and make it better. And we can have a plan to make it look better if it's not good. But I gotta look in to see, you know, where you're at. And that's the whole point of pre-approval, is it's your picture of where you are right now and what we can do.
Yep, absolutely. All right. Well, Melissa, I think we're going to go ahead and wrap it up then. I do really appreciate you spending some time and kind of talking with us about this. I know this, it's, I mean, I'm gonna acknowledge it. Usually loans are not the most riveting, most interesting topic in the world. People would much rather talk about, you know, what it's like living in Alaska and
Right.
like all the fun stuff we do up here.
I know where I stand. It's okay. Somebody's got to love doing it. It's me. It's okay, guys. I'll have fun digging around in all your stuff.
Yeah, but I do appreciate it. This stuff is really important, and you have to get this stuff done, because if you don't, your house is not going to be in order, and you're not going to be able to go enjoy your time doing that stuff, because you're going to be working to overcome a lot of stuff you could have avoided. So,
Yep,
so
that preparation is key.
Indeed. So I'll go ahead and put a link. I'll go ahead and put a link in the description section with the best way for people to reach out to you. If you can go ahead and send me best link for me to put in there, we'll go ahead and get that done. But other than that, thank you, everyone, and you know where to find us if you have questions.
Yeah, heck yeah! Thanks for having me, Jamin. All right, bye, guys.